Michael Zawadzki joins us this morning, Global CIO at Blackstone Credit and Insurance, on a quick trip to this side of the pond. Welcome. Thank you so much for being here. Walk us through those oceans and oceans of opportunities that Jim Zelter is talking about, because you have plenty of people on the other side of the coin saying, actually, this is where the cracks may be.
Well, it's great to be here. Thank you so much for having me. Maybe I'd make a couple of points on those comments. The first thing we see is this massive opportunity set. As Jim mentioned, in private credit today, the market is around $2 trillion in size. We see an addressable market of over $30 trillion in private credit. And so there's a long runway as we expand that market in what was traditionally focused on sponsor-backed direct lending to financing the real economy, infrastructure, asset-backed finance, and we think we are very early in that journey. So that creates a tremendous amount of opportunities. I would say what we're seeing on the ground in terms of fundamentals is actually pretty good resilience. Our portfolio companies continue to show strong growth. If we look across Blackstone's over 2,000 non-investment grade credits, our default rate is less than 50 basis points. I think what's important here is scale really matters, and having a global reach and footprint to access all of these markets really matters, because you never know exactly where that opportunity set may show up, and you want to be able to capitalize on it like we're seeing today in Europe, actually.
Well, it's fascinating that you bring up that keyword scale in Europe, because it's no secret that the private equity players and the private credit players of the United States have kind of swooped in to fill in that sovereign financing gap. How much of that, though, is bolstered by these fiscal promises from European leaders at the end of the day?
Look, last week, Blackstone celebrated its 25th anniversary on the ground here, and we spoke about deploying over $500 billion of capital in Europe over the next decade. It's been a great market for us over a long period of time. And so we don't view this necessarily as a distinct moment in time. What we see is a great investing backdrop here in Europe, like we've seen over a long time frame. Your corporate and consumer balance sheets are in good shape. Yes, you see an improved fiscal and monetary backdrop with some tailwinds in areas like defense and infrastructure spending. In credit specifically, because there's less capital here in Europe, we see excess spreads, we see lower leverage levels. That's why we have been active. Actually, 2024 was our most active year ever in Europe in private credit. We've built our team to over 150 people across 5 offices in the region. And as we look forward, that opportunity set I mentioned in infrastructure and asset-backed credit, it's in its absolute nascency here in Europe. We have over $100 billion of assets in that market in the U.S. We're just getting started here. And so when we look across the next decade, we see 40% or $200 billion of investment opportunity in credit alone for Blackstone in Europe.
So you're in the nascency of that and you're really leaning into it. But do you feel like European institutions are getting more comfortable with the private credit risk?
Well, I think the access to capital for borrowers as this market scales in areas like digital infra, and we heard Jensen Huang from NVIDIA say 10x compute in Europe over the next 2 years. And so I think there are huge capital needs in the market, just like we've seen in the U.S., to drive growth, to drive innovation, to drive energy and power investments. And you need private capital to meet those needs.
What about the retail investors, though? Because they're piling into private credit as well. But, of course, they expect liquidity, right? So how worried are you that that could trigger a crunch if there's a downturn?
Yeah, I don't worry about that all that much, because I think if you step back and actually look at the facts of what we're doing in private credit, inherently, it's not a very risky undertaking, right? We're doing mostly senior secured lending, first in line for repayment, 40% loan to value in large, high quality businesses, or we're doing investment grade lending, both of which are lower risk activities. The vehicles that we deliver those in, they are largely unlevered or very modestly levered at 1x. The capital matches on a liability and asset base to address those liquidity risks. And so when you actually look at the facts on the ground, and the Fed has actually looked at this over recent years, we actually feel like every dollar that goes into the private credit system actually de-risks the market, and offering individual investors the opportunity to access the excess returns, lower volatility that our institutional clients have enjoyed in private credit, that's a good thing.
Europeans love to regulate, though. So if the bigger it gets and the further it goes down into the retail space, should we just expect more regulation?
I wouldn't say that, because I think what we should expect is it's logical when you see growth in a market to see these questions be asked. But we've had those questions asked for several years, and I think as you get
the scale is getting bigger.
That's right, but I think as the education is provided, as you look at the facts on the ground, I think people will come to see that it's a real positive for the system.
Yes, I agree. It could be a positive for the system. But there is a duration mismatch, as he points out. Generally, when banks have a duration mismatch, and we learned this in the 1930s, 29, is that you want to regulate that. You want to kind of create some buffers within the system. Is that what maybe private credit is going to have to deal with?
No, I don't think I would necessarily agree with that, Guy. Most of the way our clients access private credit are in long-dated, closed-end funds where there is a strong asset liability match. And even in our vehicles that target individual investors, we have designed caps on liquidity such that we match the risk that we have in the underlying portfolios.
So they can't take their money out too quickly, basically, is what you're talking about.
We have products that are designed to match the underlying liquidity of the assets. And I think that has worked and has been battle-tested over several years in the U.S., and I think you'll see the same thing in Europe.
There's also, though, you're talking about the liquidity, that kind of safety in terms of being long duration, but there is a growing need and growing desire and growing product match in terms of being actually able to trade private credit in the interim, in the short term, whether it's via ETFs, whether it's via, endowments or pensions or whatever that may look like. Walk us through the risks of that. If you're talking about products that ultimately have that safety of being a long duration asset, what about the folks that are using it to trade in and out every day?
Yeah, I would tell you what we see in the private credit market is a lot of chatter about trading, but for the most part, we haven't seen a lot of trading. I think most of our borrowers go to private credit because they want a partner that they can see through in the long term, who's going to hold on to that loan and be there to support the credit over time. And I would say our investors look to us to originate private credit because that delivers them excess spread, excess return versus the liquid markets. And so we haven't, while there's been a lot of chatter around trading in private credit, we haven't seen that scale in a significant way. You might see it as episodically, but I don't think that'll be a huge trend.
Do we see retail taking out more of that trading base and more of the exposure to private credit?
Here's what I would say. I think when we look over a long period of time, retail has been significantly underinvested in privates, especially when you compare that to our institutional clients.
Sure.
And privates have delivered a lot of excess return for our institutional client base. And so I think it's a great thing for individual investors to have access to that. And we're delivering products that can do that in a safe way that delivers that excess return and lower volatility that our institutional clients have enjoyed for 40 years.
More interest in Europe? So I'm curious about this. You talk about this being in the early infancy of this story. There is in broader markets, there's this view now that you want to diversify your portfolios away from the United States. The United States has enjoyed its exorbitant privilege for too long, and maybe actually the rest of the world's going to outperform for a while. Do you get that sense from your investors at the moment that they're looking at Europe to do that? And if they are, how early are they in that process?
Yeah, what I would say to that is the U.S. will continue to be a very strong place to invest for our clients and for Blackstone. And we don't see that trend ending, right? The U.S., largest capital markets in the world, largest GDP, center of innovation.
It's going to continue to suck money in.
Well, I think you'll see U.S. continue to be a great place to deploy. That being said, I think some of the headlines, some of the uncertainty you've seen around the U.S. has caused clients around the world to look at other options, and they look at Europe, and they see what we see, which is an attractive investing landscape. And so I think you'll see them look to invest in both and in some cases diversify their portfolio where they see those opportunities.
There's a lot of catching up to do, though, isn't there, versus the United States?
Well, look, I think this goes back to where we started, which is that incredibly long runway and tailwind we have behind private credit, and that's why we see this $200 billion deployment opportunity for us here in Europe over the next decade.
Okay. Michael, we're going to leave it there. Thank you very much indeed. Michael Zawadzki, Global CIO, Blackstone Credit and Insurance. Thank you very much indeed.